Okay, gentlemen and ladies, welcome back. Today I'm going to be bringing to you guys some macro technical analysis and how it relates to us as dividend investors and growth stock investors or swing traders. Before I get started, you guys have to understand that there's two things that separate in passive income investors from great passive income investors. Anybody can buy dividend paying stocks and receive passive income and just simply reinvest it. It's a pretty simple concept. But in order to truly understand how to maximize your potential as an investor and to gain an edge over the market as much as humanly possible, these other things that I bring up in some of these videos are also of extreme importance, and they are beneficial to the overall game plan to make additional passive income and or increase capital, net worth, so on, so on. So let's get to it. Now, as you guys know, the market has been just falling off a cliff lately. The percentage amount that we've dropped is about 5.5 to 6.25%, somewhere in there, as of the recent high on August 1st. Now, I want to go ahead and backtrack here so you guys can see the macro chart. So this is the previous peak in January of 2022, which is about 4,800 on the S&P, or in this case, the futures version of the S&P 500. So what happened here? So basically here, this was shortly after the Fed came out and said that they were going to raise rates. And the reason being is because inflation was going up. It was skyrocketing. And the Fed raised rates, or they said they were going to raise rates. They actually didn't start raising rates until March at this peak right here. So when the Fed raises rates, what does that do? Well, basically what it does is it makes it more expensive to borrow, not just for individuals, but for businesses and, just society in general. So the Fed funds rate is linked directly with savings account interest rates, mortgage interest rates, auto loan interest rates, even like if you have a brokerage platform and you have a margin account that's attached to that, those rates also get raised. So when the Fed raises rates, all of those interest rates increase, which makes it more expensive in general to borrow. And when they cut rates, which I believe in the not too distant future they're going to do, it makes it less expensive to borrow. So that's really important to understand. So that created some bearish effect on the markets, and from the peak to the trough here, it was about a 27% drop over the course of about a year. And then we started to recover, and then we went up, 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 up. As you guys can see this trend line here. So before I get too far into this, I want to bring up a few examples of dividend-paying stocks that you guys will probably know about that will show you the effect that it had on potential buying opportunities. Now, I'm going to relay this one more time. Yield and price are inversely correlated. So when stock prices go up, yields go down, and it costs more money to create the same amount of income. But when stock prices go down, yields go up, and it costs less money to create the same amount of income or more income. So when the Fed started raising rates, it put downward pressure on the market. Investors were like, hey, I'm hands off. I want to get out of this thing. I'm going to go to cash or treasuries or whatever the case may be. And they just didn't want to risk their money, which is understandable. I mean, it was a pretty brutal bear market. I'm not going to lie. I can't even believe myself just how rough it was. I mean, some of these small cap and even larger cap growth stocks were minus 60 to 80, 90%. It was absolutely ridiculous. But anyways, so let's bring up a few different examples in different sectors that you guys can look at in terms of the effects that this had on the market and different dividend-paying stocks. So I'll start with consumer discretionary. We'll take a look at Coca-Cola, which is a pretty popular one. A lot of dividend growth investors look at this stock. So, from what you guys can see, from about the time the Fed started raising rates, about a month after the first rate hike, this thing went from basically from the peak of where it was to about where the bottom of the S&P was, about minus 19%. Another good one would be technology stock. Take a look at Apple and Tesla. So here's Apple, December 21, right here, just shortly after the Fed said they were going to raise rates. You guys can see that this thing just got walloped. And again, this is considered to be the gold standard, the safest stock or tech stock in the entire world, minus 25%. Let's take a look at another one, Tesla. Everybody loves Tesla, right? I love Tesla. It's the reason why I have a lot of Tesla. So we'll take a look at this one. And again, from December 21, just after the Fed said they were going to raise rates, all the way down to the bottom, this thing dropped about a whopping 50%. And I mean, Tesla's pretty volatile in general, but this was pretty insane move even for Tesla. It's pretty ridiculous. And actually, if I want to go even further than that, take a look at Coinbase, which is a Bitcoin play and or crypto play. This thing from peak to trough. I mean, look at this thing. It's just absolutely ridiculous how much this went down. So from November 21 all the way down to let's see, about October of 2022, which marked the bottom of the S&P, about negative 85%. This would be more for growth investors, not so much for dividend investors. So let's take a look at a different one. We'll take a look at chemicals. I'm not sure if that's a sector, but I mean, gas and oil and stuff like that is important. So this is a National Fuel Gas Company. They do pay a dividend. They're considered to be a dividend growth stock. So this one didn't start really tanking until after the Fed raised rates. But even this one fell about 17-ish%. We could take a look at real estate. Real estate's another good example. I suppose this one probably wasn't doing too bad, honestly, but once we got to, well, actually, what's interesting about this is once we got to about the end of the Fed hikes, as you can see, this thing hit, well, I shouldn't say they ended, but the bottom of the bear market in the S&P, this thing went down about 23%. This is like a dividend king or a dividend aristocrat. I'm not entirely sure which. ARKK, which also does pay a yearly dividend. This thing just got absolutely destroyed. I kind of feel bad for Kathy Woods, to be honest, because I think she's a great investor, and this thing just got walloped like it was nothing. This thing went down about 72%. So this gives you a generalized idea of what kind of effect the Fed has on the markets when we enter into a bear market and they go into this tightening cycle where they're raising rates and making things more expensive to buy and slowing down demand and stuff like that, what kind of effect it has on dividend investors and growth investors. So now I want to go through the technicals with you guys. The macro of the S&P. The reason I bring this up now in this video is because the S&P as of recently has been tanking. The Fed, like I said before, the Fed meeting minutes came out and they were still extremely hawkish as of recently. And then you had Michael Burry's big short in the options markets. And recently, I don't know if you guys have seen the news, but China's Evergrande, which is like the largest real estate developer in the world, and especially in China, just filed for bankruptcy. I mean, these are some pretty big deals. It lines up with seasonality. Pretty much every year, it's standard for the markets to drop between August through all the way to the end of September, maybe to the middle of October, before they rally for the end of the year, Christmas, Thanksgiving, when people spend money and all that jazz. So it lines up pretty synonymously with seasonality, but the events that came out recently are a pretty big deal. Michael Burry shorted in 2008, and he was right about it. The S&P had a 50% drop, which I'm going to show you guys later. Evergrande is a big deal. That's the largest real estate developer in China. And the Fed's still hawkish after they've raised rates. I think it's almost 6%, 5.5%. But I'm not going to run through the interest rates on this video. That'll be a different video. So what are we looking at here? This is kind of how I measure whether we're in a bull market or a bear market. As far as I can see on the technicals, we are still technically in a bull market. Here's the reason I say this. So what I'm looking for is, the first thing I want to look for is any trends and or support and resistance. Okay. So this would be, these red lines that I'm drawing in here would be considered to be resistance. As you can see, it got rejected here, big dump, rejected here, big dump. And then on these two little retests of the resistance also. And then this is kind of the general support area here. So you got your first support area, and then you got your, like, your kind of red flag, the last stand for the bulls kind of support area right there. So this is on the daily. We had this downtrend since the Fed started raising rates. Every time we tested it, we got rejected, and then we held the support here from June 2022 till October 2022, and then we started bouncing. We broke out of this downtrend, broke out here, retested, and then moved higher. And you can see we have this test here, and maybe a third test on the upside. So this thing recently just got rejected from the 4,600 level, which is roughly about, I think, about 5% from the all-time highs. Okay, about 4% from the all-time highs. So is this thing in a bull market or a bear market? When we take a look at the daily, well, the uptrend is still intact. This thing's actually pretty far away from the uptrend. We have not broken the downtrend. That's what I would be looking for in the bear case scenario. We have broken the EMAs, and the EMAs have had a death cross on the daily, so that's also bearish, and it got rejected off this resistance zone. But here's another interesting thing to look at. So every single time we had one of these MACD crosses down here, we had a bounce. MACD cross, bounce. MACD cross, bounce, or basically what's known as a golden cross. So we're back into the zero level. When this goes below the zero level, that's technically considered in bear territory. And I suppose the MACD could go down further. What I want to be looking for is this thing to curl up and then the EMAs to cross back over to the upside, which would indicate a golden cross. Now the RSI is at a 34. That's actually potentially a reversal level. As you guys can see, we hit it before. We bounced here, had this crazy uptrend. We bounced here. This was a pretty big uptrend. We bounced down here at about 27. That was the start of a new trend. And, you know, on and on and on and on. So I'm going to scroll out to the weekly. We're going to take a look at the bigger mega macro time frame. So the weekly actually does look pretty bearish. We cut the downtrend, started moving to the upside. The uptrend on the weekly is still intact. The resistance level got rejected at 4,600 with a candle close below resistance, indicating that the bears did in fact reject that price and took control. You guys can see that the MACD is getting ready to cross, and it's also above the zero level, which indicates this thing could potentially have a major swing to the downside. Really, honestly, don't know yet. As you can see here, the MACD over here in November 21 had a pretty similar rating at a pretty similar level, and we did have a huge dump after that. And also the RSI is technically overbought in these areas right here. Again, back here, you guys can see that it was overbought for some time, kept moving up, and then eventually we dumped. So the RSI has had a bear cross. The MACD is about to have a bear cross that's bearish. But, however, we did have a weekly close here. Usually, if it wasn't closed, you guys would see like a little timer here indicating the days and hours and stuff like that. So we had a little wick here. If this thing bounces from here, it could go back and test 4,600. What I would be looking for is a close below that blue EMA there with a body close, a red candle. That would be the first warning sign. And then the second warning sign would be, do we retest this green trend line here at 4160? Or do we just dump straight down below it and go back and test the lows? So I'm going to take a look at the big, great, grand scale of things here on the actual SPY itself, not the ES or MES, I mean. You can see a pretty similar setup on the SPY. It looks almost identical to what the MES looks like, but I'm actually going to change this up a little bit. So I'm going to get rid of these EMAs, and I'm going to add some simple moving averages because this is kind of like my are we in a bull market, are we in a bear market kind of indicator setup here. So change the first SMA to a 50. Change the second SMA to 100. And change the colors so that way it's, we can differentiate which is which. And the third one, I want to move that to a 200 weekly moving average. Probably make this one, I would say green to indicate buys. And probably switch this one to red. Okay, so this is my bull bear market weekly setup right here to determine whether we're truly, really going to see a huge capitulation or we're going to keep moving up. Anytime that the weekly price action bounces off of this green trend line here, or EMA, or SMA, I mean, the 200 weekly, every single time it's ever bounced off of this thing for like almost 15 years, it's gone up historically. So I'm going to show you guys what I mean. Okay, this is 2022. We bounced, went back above all the SMAs, and we're sitting right here. With the exception of COVID, that was a black swan event, as you guys know. Or I probably shouldn't say that. I'd say the zombie virus. But anyways, so there's that. I think that would be the exception. That was a black swan. You guys can see it right here when the Fed started raising rates back here before President Trump forced him to cut rates. Market came back and tested it, then went higher. 2016, tested it, went higher. 2011, just after the great financial crisis, tested it, went higher. Now, here's what I would be looking for in terms of warning signs. So we tested it here in 2008. Tested it. We were just kind of bobbing around on this thing. We came up and rejected the 50 and the 100, and then we fell below the 200 SMAs. This candle, I'm going to actually zoom in here. You see this red candle right here on June 2308? When we got a close below that 200 moving average with this candle right here, this would have been the first warning sign for me to say, okay, things are getting bad. We're really going to fall off a cliff here. It's time to change up the game plan for me personally, not financial advice. That would have been the first warning sign. If that didn't hold, I'd have been like, yikes. Okay, maybe I need to pull back here for a minute. And then we go down and we come up and retest this thing. And this is where it gets scary. So come up, retest it, and then boom, we just absolutely tank. So from that retest all the way to the bottom was almost a 50% drop on the S&P, and I'm sure the other indices were probably similar. So this would be like the bear case scenario right here, macro bear case, like holy crap, this thing's just going to fall off a cliff, everything's going to go to zero, all of our invested money is going to just disappear. But of course that never happens. Markets go up, right? So let's go back to modern day. Go ahead and wrap this video up and take a look at the macro bull bear case scenario here. So the question becomes, for passive income and growth stocks, are we in a bull market? Are we in a bear market? The Fed has been raising rates, but we tested the 200-week moving average and we've moved nearly back to all-time highs since that time. We are above all three of these SMAs. I think personally that we're not going to go into a bear market. I could see us testing on the EMAs at maybe 42, 4,300, and then bouncing and going back up to 4,600, testing it, maybe consolidating there for a while, and then heading to new all-time highs closer to the end of the year, which again is seasonality. That's usually how it works. October through December is always bullish. The thing I would be looking for here is a close below this green level, and we just haven't gotten it. I mean, everybody, the market's dump and everybody wants to freak out and be like, oh my God, everything's going to zero. Guys, not financial advice, but in my opinion, everything is not going to go to zero. In fact, honestly, I don't think we're going to have a huge bear market, but if we do, well, guess what? It's a great buying opportunity because, again, when stocks are cheap, you can pick up more for less and you can get more passive income for less money. And it makes it easier to accumulate wealth and to increase your income to hedge against the bear case scenario when the markets go down. So anyways, hope you guys enjoyed this video. Hope it was informative. It's a bit long because I have to go over all these metrics with you guys. So hopefully you stuck around. Please like, comment, and subscribe, and I will see you all later. Peace.